Hello and welcome to this week's instalment of Nucleus Investment Insights. In many contexts, Australia has often been referred to as the lucky country, with our performance in this latest pandemic no exception. COVID has brought immense disruption to the Australian way of life, but at the same time, there are now opportunities that lie ahead in the post-pandemic rebuild of the Australian economy. There now lies a rare chance for a review and reset of national issues like the right level of immigration, the importance of government taxation and support, with a focus on how it's appropriately applied, to a complete review on the creation and distribution of the nation's energy resources. The challenge now lies ahead for policymakers to leverage and not squander this luck into meaningful change and embrace new thinking to ensure prosperity and equity into this century. It's a huge topic and worthy of a considered approach, so we are lucky to be joined in the studio today by Professor Ross Garnaut. Professor Garnaut has had long-standing senior roles as policy advisor, diplomat and businessman dating back to the late 1970s. He's currently a professorial research fellow in economics at the University of Melbourne and is the author of numerous publications in scholarly journals into international economics, public finance and economic development, particularly in relation to East Asia and the Southwest Pacific. His recent books include The Great Crash of 2008 with our own David Llewellyn Smith, Dog Days, Australia After the Boom, 40 Years of Reform and Development in China, and Superpower, Australia's Low Carbon Opportunity. Ross has just released a new book entitled Reset, Restoring Australia After the Pandemic Recession, and joins us today to share some highlights and pathways going forward. Professor Ross Garnaut, welcome to Nucleus Investment Insights.
Good to be with Nucleus.
And also joining us today is one of Ross's past partners in crime, or maybe partner in tome, and our own chief strategist here at Nucleus Wealth, David Llewellyn Smith. Hello to you, David.
G'day, Tim.
And sitting alongside, or over the road from Ross, I should say, at the mandated distance, I'm also joined by Nucleus Wealth's Head of Investments, Damien Klassen. How are you going, Damien?
Hi, Tim.
Lovely. And just a quick reminder that before we get started, if you haven't already, to subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And of course, for those listening in live, feel free to drop in your questions of Ross in the YouTube live stream chat to have them answered along the way. So we'll jump into the agenda for today. So we're going to kick off with some economic background to the pandemic recession, and then we're going to be rolling into the solutions as well. So jumping into, we've sort of earmarked, I guess, some key areas of note. So full employment, optimal debt, tax, and then rolling into the energy and climate change options in front of us as well. And then, of course, wrapping it all up in an investment outlook and how we can use these themes every day here at Nucleus Wealth. So with no further ado, let's jump into it. And I'll hand over to perhaps Ross to begin by giving us a little bit of background on perhaps why you decided to write the book and I guess where you were wanting to guide the national discussion.
Assessing where we're at these big points of decision is what I do, and my wife Jane and I spent COVID in Barcaldine, right in the middle of Queensland, and the University of Melbourne asked me to fill the empty hours of students and others with a series of lectures on the implications of the pandemic and what came after it. So the book began as a series of 6 lectures in the middle of last year, and put it together as a book after that. And what it seeks to do is assess where we're at. In the first half of last year, both Australia and the world had the biggest, sharpest downturn the world economy's ever seen in a 6-month period, and the Australian economy's ever seen in a 6-month period. That has implications, and so I wanted to describe and assess where we're at and talk about where we go next. Now, at that time, in the first half of last year, the people in government were talking about the ambition of snapping back to what we had before the pandemic. And when I worked through what that would mean, became pretty clear that first, we shouldn't want to go back there. They were the dog days, and secondly, we couldn't get back there even if we wanted to. So we've got to do something different, and if we do things differently, then we've got some pretty big opportunities. It can be a pretty good future. It can be a future that gives us full employment by 2025, real full employment, not the high unemployment stuck at 5.5% that we had during the dog days, and growing incomes after that. I think the choice is as stark as that, and the book is framed around Australia's choice between going back to the dog days, but things actually being worse than in the period 2013 to 19, because circumstances will be harder, and restoring Australia after the pandemic recession.
Okay, very good.
So, and maybe just to give a bit of terms of reference to anyone who hasn't read Dog Days, and sort of the idea behind that, low wage growth and low per capita GDP growth. Maybe if you want to give a bit of background.
The comparison both with the 2 decades earlier and with other countries is pretty stark. We had continuous economic growth without recession from 1991, the end of the last recession, and the pandemic until the recession hit in the first half of 2020. 28 years of unbroken economic growth, the longest continuous period without recession that Australia's ever had, not only Australia, than any developed countries ever had. Pretty extraordinary period. But when you look closely, that wasn't a continuous story of good economic performance and prosperity. It breaks into 3 periods. The first decade, up to about 2002, was the productivity boom on the back of the Hawke reforms of the 80s, continued with diminishing momentum through the Keating years and the first few years of Howard. And then those reforms were reflected in the developed world's strongest productivity growth. We're top of the world league table on productivity growth in the 90s and the first year or two of the century. Well, that's an unusual position for Australia to be. We won the wooden spoon in most decades of the 20th century. We're the worst performer of all the countries that are now developed. In the first 7 decades of the 20th century, we were the best performer in the 1990s. So that's a pretty interesting story. And then productivity growth petered out from the first couple of years after the first couple of years of this century, but incomes growth kept going. Output per person continued to grow, and incomes growth grew even more. For another decade, incomes grew. Australian prosperity grew on the back of what I call the China resources boom. This was driven by the world's most populous country, more people than in all the developed countries put together, growing faster over a sustained period than any economy ever had. Not only faster, but with greater resource intensity and energy intensity than any other growing country had ever had. All of those things gave Australia a huge lift in terms of trade and in opportunities for productive investment. And that's what kept Australian incomes growing until the end of the China boom in, I date that as 2012, China's adoption of a new model of economic growth. And the change in gear in China towards a new model of growth that gave less emphasis to investment, more to consumption, more to services, less to heavy industry, more to environmental concerns, less to growth at any cost. And that change of gear completely changed downwards the trajectory of growth in demand for minerals and energy. So that from 2013 onwards, we didn't have the China boom. And economic growth kept going, but it was a very different form of economic growth. Between 2013 and 19, the years I call the dog days, we had the lowest growth in output per person of all developed countries, much lower than the OECD average, very much lower than the US, lower even than Japan, which we think of as a bit of a basket case in economic growth. Well, we were lower than that basket, and Australians weren't much aware of that. I think because total economic growth without recession kept going mainly on the back of unusually high immigration. Also immigration that changed in character. In the 21st century, a much higher proportion of Australian immigration has been temporary migrants. Although temporary migrants were often given the label of skilled workers, in practice it contained a very high proportion of people without highly valuable skills. So we had growth in total output, but not growth in output per person. A couple of other measures of underperformance during the dog days. Real household income per capita did not grow at all over 7 years. Now, that's very unusual in a developed country, other than in war and catastrophe, since the Industrial Revolution. It's very unusual in Australian history. You don't find much more than 7 years in the Great Depression, where you got no growth at all in real per capita household income. Another measure is underperformance on unemployment. We didn't have the very high unemployment that the US, Europe, other developed countries had during the global financial crisis and the immediate aftermath, mainly because two things. One, we had very quick and large fiscal and monetary stimulus, bigger than most other countries. Secondly, China stoked up its economy.
It had an even bigger fiscal stimulus.
In response to the global financial crisis. And that for a few years kept the resource side of the Australian economy going. So we didn't have the big dip that other developed countries had. But by 2013, just comparing it with the US as I do in the book, our unemployment rate was still about 5.5%. It hadn't increased much since immediately after the GFC. The US started after GFC 10 and had come down a couple of percent by 2013, but was several percentage points above Australia. Then during the dog days, we got stuck. We were as high at the end of the dog days as at the beginning, and the US went down from several percentage points higher than us down to 3.5%. So we were a miserable performer compared with other developed countries. US, a very clear comparison. And the fourth measure of underperformance, the growth in underemployment. Not only did the unemployment rate get stuck at what I think is a relatively high level, unnecessarily high level, but unemployment's measured by people having worked for an hour in the week before the survey. Well, those who couldn't get as many hours work as they wanted increased enormously through the dog days. Underemployment increased enormously. Jeff Borland, University of Melbourne, he puts out a very interesting periodic note on what's happening in the labour market. He put one out yesterday saying that if you take into account underemployment, then then the growth of underemployment should lower by a full percentage point the rate of unemployment that we can consider to be full employment. It was big in the whole story. So poor performance compared with other countries, poor performance on productivity and incomes growth compared with the first 2 decades of the long expansion. They were the dog days.
Excellent, thanks. So that's a very good wrap up. I had some other leading questions, but I don't think I need to ask those because I think you've hit on most of the points. I wanted to sort of give people a frame of reference. The next sort of what I wanted to sort of ask a lot of questions about, sort of going through this, is not so much what's in the book because you've done a very comprehensive view of it. I guess what I'm interested in is some of the likelihoods, and especially from us from an investment perspective. I'm looking at some of this going, yes, I think that looks like a good plan. But I don't know if there's political support for that one, and so and I guess that's what I want to try and gauge for you is some of these
likelihoods.
Likelihoods and how much extra work really needs to be done at the political level for some of these, or how imminent different ones are. And so maybe we could start with the full employment. So you speak about sort of two main paths: domestic spending and exports. And so on one side we need to get the Aussie dollar down to increase our competitiveness, and on the other side we need to get people spending. And I guess my take would be increasing getting away from inequality, getting back to more equal will probably help on that side. It seems as if the current government's plan, though, is reduce the housing market and hope that flows through to the rest of the economy. I don't know whether you got any thoughts on that.
Yeah, I think it's a cop-out for us to say the government's not doing anything, so things are hopeless. We live in a democracy.
Yep.
It's up to us. If the public discussion isn't pushing the government into doing the right thing, then we've failed as citizens. So that's one of the things this book's about.
Okay, so maybe what I should rephrase it: which one do we need to do more work to convince the government, and which one are they almost there on? I suppose.
Well, I think it was a very open question when I put this book to bed late last year, or I did a bit of an update after the US elections because that was
made a big difference, obviously,
because that was such a big story. So, but most of the book was to bed by a bit before that. And I said then, after the budget in October, that the budget left open the question, the October budget left open the question of whether we would choose post-pandemic dog days or post-pandemic restoration of Australia. We did a pretty good job, I think, on fiscal expansion. Now, we had to do that, or we would have had a very much deeper slump. It was deep anyway.
Yep.
In the first half of last year. Now, there's a lot of criticism of a lot of wasted money, a lot of money going to people and companies that didn't need it, who'll squirrel it away, so it's not even there for keeping up demand when they spend it in future. And you can make all of those criticisms in retrospect, but I've been an official with those sorts of roles in the past. The Treasury had to come up with the package very quickly. The government had to respond to it very quickly. So it's absolutely inevitable that you'll make mistakes.
Yep.
Now it's right. It's quite right now to analyse the mistakes and draw attention to them. But the broad strategy of quickly spending a huge amount of money was right, and that was right. The critical thing on fiscal policy, or two critical things. One is that we keep it up until we're approaching full employment. And then we've got our eyes open to the possibility that we'll have to pull it back a long way.
Do you think they'll keep it up until we reach full employment? It seems as if there's certainly noises being made about pulling it back already.
Well, end of the month, isn't it, for JobKeeper, JobSeeker, if that hasn't changed?
Yeah, well, I wouldn't keep on those same programs. We've got to shift. All of the programs so far have been about boosting consumption. Well, at least the good parts of the program have been about. We've got to shift towards building incentives for expansion of production and investment in the trade-exposed industries, the export industries. And why we've got to do that is if you have your whole expansion on the back of increased domestic expenditure, government expenditure, or even housing expenditure for that matter, you're running up greater external debt, which sooner or later is going to be a constraint, and it's going to be a constraint on living standards in future. It'd be different if the debt was funded by the Reserve Bank, but to the extent that it's building up foreign ownership of Australian assets, which a lot of it was through 2020, then you're building up debts that will lower living standards when they're repaid. How quickly you need to repay them depends a lot on circumstance at the time. If when the time comes, we've got for full employment, we've got very low levels of investment, so there's surplus savings. It may be appropriate for there still to be some government deficit at that time. That's to be worked out at the time. But there is a risk that we won't do all those calculations very precisely, and we'll pull back too quickly. But it will be a mistake just to continue the consumption sort of expenditure, subsidising holidays in whoop whoop.
Absolutely. There's not a lot. If you build up debt for a holiday, there's not a lot. But if you build up debt for building new factories or infrastructure or whatever it is, there's obviously
that's right. And then you've got to get the right balance between fiscal and monetary policy. I'm very critical in the book of monetary policy being tighter than other developed countries when we didn't have a stronger economy than other countries.
Yes.
Combination of whatever your fiscal policy is, the easier your monetary policy, the lower your dollar. And if you don't have a stronger economy than other developed countries, then your exchange rate will be unnecessarily high, and you'll be removing incentives for investment in export industries, investment in the future. You've got to have a balance between the two if you want to get to full employment with a manageable level of debt.
So Ross, you noted that we're still accumulating a lot of foreign debt through fiscal expenditure. How much more aggressive would you be with the RBA if you were in control of that lever to mitigate that with more money printing?
The answer is March from 2013 to the end of
yes.
to the end of 2020. The world has changed. The governor made a series of speeches in the first half of February, mostly in 1 week, I think.
Yeah.
That brought us almost up to the European and North American approach to quantitative easing. Not quite, but since then they've gone even further.
And have they gone far enough, is the question.
Well, they haven't talked much about how long they'll sustain. The current level of Reserve Bank buying of bonds is very high, so I wouldn't criticise this last week's level. But what happens next is the important thing, as it is in fiscal policy. But if they go, but I'm not critical of the last couple of weeks' policy. That might go far enough.
And actually, I've got a question along those lines, because David and I speak a lot about the RBA being sort of behind the curve, behind everyone else, sort of like following what everyone else was doing a few years ago and just repeating what these guys did that, and so. Whereas the other day they came out and they doubled the amount of longer-term bond borrowing, and the European Union gave a few comforting noises, but it was crickets from the US. Do you think the RBA would feel as if they were sort of saying, "Come on, everyone, let's go this way," and then nobody came, and they're sort of like, "Oh, just a minute, we're too far out in front. We need to back and get closer to everyone else"? Or do you think they're happy to be?
Well, the governor has articulated very clearly now a commitment to maintaining monetary expansion until we've got full employment, and measured appropriately. Full employment's when the labour market's so tight the wages are rising in the marketplace. That's the proper measure of full employment. And for first time since Nugget Coombs, the Reserve Bank's articulating the objective of full employment in an economically rational way. So having come to that point, they may hold their ground and keep monetary policy where it is until we do have real scarcity of labour, real wages rising in the marketplace.
Yeah, because I guess especially if you're starting to see, say there's some pretty big packages going through the US, and say there's another infrastructure package coming after it, and they are actually starting to get some positive signs, and their central bank's backing off, whereas over here maybe our government's not doing the same. I'm interested in that thought process of saying, will we be prepared to stand on our own, or are we sort of more happier to?
Well, through the dog days, we did stand on our own.
On the wrong side,
backwards.
So the problem with the RBA is not that they're not prepared to stand alone, but that they were standing alone in the wrong place.
Yes, okay. Optimal debt. So you speak a lot about the debt side. I guess one of the things I'm quite interested in is is the limits. So Australian household debt is much, much higher than what we've seen elsewhere. And I can sort of look at, say, European or US debt and go, well, it's a fair bit lower than where it was at the end of financial crisis. If they sort of set in policies to try and ramp it back up again, maybe they'll be successful. I look at the Australian household debt and sort of say, look, it's pretty high. Yes, interest rates have come down, so there's a lot more affordability in it. But it seems that at some stage people will say, well, maybe I don't want a $2 million mortgage, on $100,000. Maybe $1 million was enough. I just wonder, in your mind, is that a constraint on, or how much of a constraint, I guess?
Well, just on household debt, alongside that unusually high indebtedness of average Australian households, we've got unusually high assets.
Savings. Sorry. Yes.
Asset values, so that there's not necessarily current stress reflected in that.
Yep.
Well, the vulnerability would come both for the asset prices and for the servicing of debt if you did get a substantial increase in interest rates. So your question is really a question about the odds of that.
No, it's probably not. It's not about that. It's saying, well, let's say interest rates are kept where they are, but I guess to me there's a psychological issue about saying, okay, I might have 5 or 6% interest rates, and I've got a $300,000 mortgage, and I'm gradually paying it down. And I can see it, and I can feel good about myself. Now we've got interest rates for 40% of that, and it might be paying the same in interest, but now I've got $1 million mortgage, and the prospects of actually paying that $1 million down is like, well, somebody might be looking at it going, I'll never pay this off. Whereas a $300,000 mortgage, they can actually see where they'll pay off. And so maybe with a $300,000 mortgage, you take a few more holidays, or you spend a little bit more elsewhere. Whereas with a $1 million mortgage, it's like this.
Take overseas holidays and make the debt even bigger.
Yeah, exactly. I guess what I'm saying is there, regardless of the interest, if the interest payments on both those might be the same, but whether there's a psychological, I'm just not interested in any more debt.
I don't think there is, mate. You put forward a hypothesis. My first reaction to that is there's not likely to be much in it. No, I think the times of vulnerability would be if interest rates significantly increase. Then, of course, there would be vulnerability, and so the question is, what are the chances of that?
Well, and it's almost a bit of circular, though, isn't it? Because if everyone's got all that debt, then you don't have to worry, because you only have to put interest rates up 25 basis points, and all of a sudden everyone's feeling the pain.
Yeah.
And
So what's your view, therefore, on inflation, Ross?
Well, there's two, and I talk about this in the book, there's two different stories. One is global inflation, which first of all is US inflation, and then there's Australian inflation independently of global inflation. I don't think there's a risk of Australia inflating independently of the rest of the world, of the US and the rest of the world. Now, Europe, Japan, Korea, Europe, including the UK, are much less, they don't have the same fiscal expansion as the US, much less likely to be inflationary. So let's focus on the comparison with the US. And I am saying that it would be a mistake, while our labour market is as weak as it has been in the dog days and is at the moment, to run monetary policy tighter than the US. And US is, Powell, the Federal Reserve chair, he's articulated a commitment to keeping the spigot open until they've had a period of inflation above the target level for long enough to bring them into the target on average. So that's a commitment to a long period of monetary expansion. Now, before that's over, it could get inflationary. I think it would be a mistake for us to bet against the Fed, to stand against that wind, and so I wouldn't run tighter monetary policy than them in the period ahead, given where we are, that means if the US gets inflationary, there's some risk of some inflation coming here. I wouldn't see that as a major focus for policy action unless we were at full employment. If we were, then we would have to pull back. Really important, and I emphasise this in the book, that we don't pull back on an overheated economy in future in the same way as we did in the past, simply by jacking up interest rates. That gave us the Whitlam-Fraser recession. It gave us the Hawke-Keating recession. It gave us the Fraser-Howard recession, and they're pretty nasty. And because the markets have seen us do that a number of times, they presume that we'll do it. And when you do that, you jack up the exchange rate to uncompetitive levels, just when you need a
manufacturing sector,
a more competitive exchange rate, and expectations that we'll do that again will inhibit investment now, because no one's going to invest in processing iron, except Twiggy Forrest, for whom a few percent on the exchange rate one way or another doesn't make much of a dent in wealth. But the general run of investors is going to be very cautious about investing in export industries if they see the possibility of higher interest rates jacking up the exchange rate sometime in the future. So I think we need to be articulating now an approach to tightening fiscal policy later on, so that everyone knows there'll be a balanced tightening of fiscal and monetary policy. It won't all come in higher interest rates and a higher exchange rate.
I'll just go back to a point you made earlier about, and you make this quite strongly in the book as well, about one of the inputs into the dog days was the transition in the immigration program. And we can see the Morrison government looking to reboot that already, probably along similar lines. And you talk about the possibility of a little bit of inflation trickling in here from the US if they get their fiscal boom going and the long monetary expansion. So do you think, how difficult will it be in current circumstances for the Morrison government to ramp up immigration? And how heavily do you think that would weigh on a possible recovery in wages here?
You can ramp up immigration a long way from where it is now to getting back to the levels of the dog days.
Yes, you can.
There was negative immigration last year,
yeah.
And I read somewhere, it might have been in macro business, that there was negative immigration in January.
Yes.
What I'm saying is we shouldn't stop immigration. We should do two things. One, establish now a commitment to a moderate level of immigration. I'm suggesting going back to the sort of levels of the 90s, adding about 0.5% per annum to the Australian population by immigration, compared with 1% during the dog days. And I'm also suggesting a reversal of the big change in immigration policy in the 21st century, the shift to temporary migration. I think that's been particularly damaging for wages. It's led to unskilled labour in the bush, which used to be the underpinning of the living standard of people with not very good education and skills in the bush, Australians. But now, no farmer or small business in the bush thinks about training an Australian. That's hard work. You bring in a backpacker from Europe or from the Pacific Islands or some other category of temporary worker, and you don't need to go to all the trouble of training a young Australian. And around the cities, the unskilled jobs are overwhelmingly done by temporary migrants these days, and I think that's that was a big drag on real wages, probably especially in the resources boom. We had the biggest investment and terms of trade boom in Australian history in the China resources boom, and real wages hardly went up at all. I think that
one of the oddities of the debate was that we were very the government and the press were very explicit about high immigration as a way of containing wage inflation during the resources boom, but then suddenly afterwards, when we had diminishing investment, then the same immigration regime suddenly didn't impact wages, which is all a bit silly and driven by vested interests, I think.
Yeah, well, it certainly wasn't driven by economic analysis and knowledge. So how big a drag will it be? I think if we went back to the immigration patterns and levels of the dog days, it would substantially delay return to full employment and rising wages. But there's plenty of room for having a moderate objective, changing the composition, go back towards more long-term migration, and at the same time setting a level of migration that we know is consistent with rising incomes of ordinary Australians.
And just in the wording of this, I need to get this right for how you're talking about, how you wanted me to word it. Do you think the government will come to this conclusion on their own, or do they need more political pressure to get there?
Well, I actually think that if they tried quickly to go back to the dog days levels of immigration and temporary immigration, there'd be a big political reaction against it. So, but we're so far from that you won't get that reaction soon.
Well, maybe 457 visas. There doesn't seem to be any movement there yet, though, on that side.
To modify.
Yeah.
Well, no one's coming in on them. My suggestion is that for all those types of temporary visas where you're supposed to be only recruiting scarce and valuable skills, that we say you can't employ anyone on those visas for less than average weekly earnings.
Yes. I thought that was a good suggestion. Yeah. Yes. It's, that you have a number of farmers. I suspect the National Party will be up in arms against that. So, yes.
Yeah, well, not all farmers, and when you explain the situation, now then you'll have less opposition, and when you join that to one of my other suggestions, the minimum basic income, changing the nature of Social Security and taxation arrangements, integrating the two around the idea of a minimum basic income, there'll be less upward pressure. It'll be easier to recruit young Australians for unskilled jobs, for example, in the bush, because
it's basically a bit of a subsidy, effectively, for some of those roles.
Yeah, if their income is below the level at which you've paid back in tax what you've taken in the minimum basic income, then you get a bit of a top up, and I think that'll make it easier to get people into unskilled work generally, but especially in the bush.
Yeah. Now, I wanted to ask you on that front. I've always had a bit of a. So you spoke that being untaxed, and to me, whether it's untaxed or taxed, just slightly higher, or it doesn't really make that much of a difference. But I'm actually interested in that role of saying, in terms of as you're starting to head down the MMT path, of saying, well, if we gave the RBA the ability to top that payment up with a taxable, just to say, okay, well, demand's a bit light. We've already lowered interest rates as far as we want to lower them. Let's top up everyone's UBI and let's make it 20 grand for a year, or let's whatever it is until we get to the next level. Do you see that as a
well, I do.
What the floor is in that?
Yeah, I not exactly that, but a variation on that theme. I do say that we would do well to put in place mechanisms that tighten fiscal policy when we've got full employment, and do that fairly automatically, or at least give an independent body some authority over that. And one problem with the RBA being independent and given a responsibility for macro stability, but only one lever, that if you've got inflation, they'll pull that, and you jack up the exchange rate and tell Toyota to go home. If you'd call it something else, I call it an economic stability board. But if that had in front of it some fiscal levers as well, and across the board increase in tax rates of 5% or 10%, or reduction in tax rates accompanied by a top up of the minimum basic income, that they can use within broad policy parameters to either pull back an excessive boom, so you're not only jacking up interest rates, or to provide some automatic stimulus when it's needed.
Yeah, because for me at that stage, then you can say, well, effectively, if it's taxable, then you're helping the government at the same time as helping people, but also you could get to the stage where you're actually saying, well, maybe our minimum interest rate shouldn't be 0, maybe it should be 2 or 3%, and have all these other levers to actually to keep you away from that zero bound where you start to jack asset prices to...
Yeah, I two questions there. I think we need the fiscal lever as well as the monetary lever, so that's a good point. That's a good point you're making. I think we've got to be careful in setting our minds against zero interest rates because it may be if in the world as a whole people are wanting to save more than they're wanting to invest.
Yes.
Then you won't get full employment, you won't get economic growth unless you've got zero or negative interest rates. That's just an economic fact of life.
Well, I'm certainly not against you on that, but on that side I'm just saying in some way of throwing so much fiscal that you don't need to get to that level. But anyway, let's leave that aside because that's probably all hypothetical. Negative interest rates, the RBA has obviously spoken a lot about saying it doesn't want to go there. Do you think
I think that's silly to say you don't want to go there. A number of countries have done it, and the IMF did a little bit of a study. I noticed in one of their blogs a couple of weeks ago from the IMF that they've done a bit of a study of negative interest rates, and they work much like falls in movement from 0 to negative. It moves much the same as a fall when interest rates are positive. Of course, yes, it does have some positive impact on asset values. That's a different question. David and I, way back in the book about the Great Crash, said that you've got to deal with that problem through macroprudentials, and you still do.
As a quick aside, would you slap APRA and the RBA back together under the same roof, or do you think they can operate effectively separate?
I think they work better together. In fact, I'm saying put something else together, put the macro responsibilities of Treasury back there as well into the one integrated body. So you've got one body choosing between the combination of interest rates within a certain range, increases in or reductions in tax rates and macroprudential.
Yeah. And you're going to leave the politicians nothing but sexual harassment, right?
No, they've got the huge job of setting average tax rates. The macro stability stuff is varying that, and you can have a big argument about more or less equity, higher taxes, and more public expenditure, or lower taxes and lower. That's a crucial debate that has to be sorted out politically, and that's not affected by these macroeconomic things, and on the composition of expenditure programs and tax programs. That's all for the politicians. What it does is leave only the questions with real political content to the politicians, rather than having all of the political energy and time going on to questions that are actually better handled by an independent body.
So you mentioned it to me as well that during your time in central Queensland that there was something of a groundswell of jobs appearing in the new industries in renewable energy, and that you thought over time that this would overhaul some of their dependence on coal jobs, etc. So, just as a segue into that, as part of the book as well, and your propositions for the superpower in energy, would you like to go there?
Yeah. Well, the superpower story, that was the book at the end of 2019, and I update that story and show where that story fits into the macroeconomic story in this book. But Australia has immense opportunity in the zero emissions world economy because of two sets of resources. One, we've got by far the richest renewable energy resources in the developed world per capita. Per capita is what matters in international trade terms. But absolutely, probably per capita by a country mile. And that means that if we don't mark it up, and of course you can mark up anything, but if you don't mark it up, we've got the lowest cost energy in the world when the whole world's heading towards zero emissions, and the whole world is. First of all, the developed world in China, and that's a hell of a lot of the economically relevant world. That's the world in which prices are set for metals and other industries that use a lot of energy. The decisive change there is Biden's election, whether the US is joining the other developed countries. We could hide with the US when that big country was standing outside the developed country consensus, but with the US not only joining it but leading it, and Biden saying that they're going to make sure the rest of the world gets to zero emissions by 2050 as well as them. Well, in that world, there'll just be very large opportunities for exporting energy-intensive goods. And we've got all those minerals. We're by far the world's biggest exporter of minerals that need a lot of energy to turn into final products, aluminium or iron ore. By far the world's biggest exporter of both of those. The natural place to turn them into metals in the zero emissions world economy will be in Australia using renewable energy. The other big advantage we've got is carbon in the landscape is a very valuable resource in the zero emissions world economy. There's some parts of the world economy that will be hard to get to zero emissions, and so for quite a long time countries will be looking for negative emissions for offsets, so we can generate them much more in our farms, in our coasts, much more cheaply than other countries can, in our soils, in our plants, in our coastal oceans. And in addition, the whole world will be making plastics, chemical manufacturers, things we currently make out of fossil carbon and hydrocarbon, out of biomass in the zero emissions world economy, and because we've got 10 times the level per capita of woodlands per person that the developed world as a whole has, and the developed world's got a lot more than the developing countries have, we've got a big advantage in producing biomass for industry. So use these opportunities well, and we can transform the Australian economy in the zero emissions world economy, and it's much bigger and more sustainable than our advantages in the fossil energy economy. You might think that producing 40% of the world's iron ore, 60% of the iron ore imported into China, plus being by far the main source of metallurgical coal, would give us an advantage in steel making, but it costs no more for a tonne of Queensland or New South Wales metallurgical coal in Corbeil or Shanghai as it does at Whyalla. In fact, it costs more at Whyalla, but it's not going to be like that when it's renewable energy or hydrogen or other hydrogen carriers that's the medium for processing, because the international transport costs of renewable energy in any of those forms are very high. It's going to be much more economic to use the resources at home.
Yeah, so that's actually where I wanted to lead. I've got a few charts up there I just wanted to run relatively quickly through. The top ones, this one's just our one we've been running for a long time now. We've got much longer versions of it, but it's basically just saying, look, coal and gas and nuclear are all on these scarcity curves. The more you need it, you got to dig deeper and things like that. And so those fixed pretty costs, and the solar and particularly solar plus battery is coming down dramatically in cost, and looks like all the movements forward in terms of just increasing number of scale and all that type of things is just driving that cost lower. And I sort of haven't put countries in here, but what you're saying there, obviously producing solar power in the middle of Australia is a lot better than you get a lot more resources than what you do in the middle of London.
Yeah.
And so that's sort of like the broad overview. It seems to me a lot of people seem to be very focused about where we are today on this curve, as opposed to where we're going to be in 5 years' time, and that's I guess that's a little bit of an aside. But I guess the question I wanted to ask in terms of that transport side of it was sort of moving to the next few. I'm stepping this way through.
Just before you leave that last one, the problem isn't that people are looking at where we are today. They're looking at where we were yesterday.
Yeah, exactly. Yeah, and as you said, it's that whole gas. It's a gas. The gas is our transition fuel. Is like 20 years ago it was, but it's time's passed.
Yeah. Because we didn't get on with the job of the transition early enough, we lost the chance for gas.
Yeah, absolutely. And then I'm going, okay, so on the part about the, if you've got a car, for example, so I'm just using big picture numbers. US has got using 22 quadrillion BTU of oil for motor vehicles, but they actually only need 4 quadrillion BTU of mechanical energy. You waste so much in a car engine that, and so then you come back to electric cars and you go, well, because if they're getting their energy directly from sunlight, they actually only need 7. So you actually need about a third amount of the energy is what you need. And so that doesn't actually, for me, the numbers then go, well, if you don't need as much, and even when you get quite aggressive out things, it doesn't seem to me that the electrical grid actually needs to scale that much on an annual basis. It's sort of, if you converted across, it might be 3 or 4% per annum. And even if you're quite aggressive about your rollout of electric vehicles.
Yeah, I think I've got some numbers in the book. I think if complete electrification of transport might increase electricity demand by about a quarter. Whereas as you say, the actual energy now we use on the road is about as much as the electrical energy we use, but we'd only need to increase the load by about a quarter. The electric car, it uses energy much more efficiently. It uses a much cheaper form of energy. Once we get the technology right, well, the technology is there now. Once it's being delivered,
once the price gets down to the right level,
people will be using it off their own roofs if they've got their own roofs. So a cheaper form of energy, and it's a much simpler motor. So the capital cost of an electric car, once it's had as long a history and it's got the same scale, it's going to be a fraction of the capital cost of an engine for an internal combustion engine. Because it's simple, around about 40 moving parts compared with nearly 1,000 in an internal combustion engine. Doesn't take much maintenance. Now that is a bit of a structural adjustment challenge. All these motor mechanics won't be needed so much, but there's lots of other things that will use their skills. But we do have to think of that structural adjustment. So this one's a real no-brainer. It's going to come much more quickly than people think, and the countries that do it first will have advantages. We're actually the laggard of the developed world.
Yes. Can you go to the next one? And sorry, so the final point of this was then, if you look at the battery side of it, if you look at hydrogen in particular versus these, as you say, okay, well, if you've got a direct charging model, you get sort of 95% from your car battery, and then you go down to, if you have to send it back through AC and DC, it actually ends up only being about 75%. So there's a big benefit in terms of just going straight into your battery. Hydrogen, because you've got to do the electrolysis, and you end up only 50%, and the transport's a lot more. So I guess where I'm trying to go to here is, so you do speak a lot about hydrogen, and I guess I'm just looking at these headline figures and going, well, hydrogen's roughly as efficient as fossil fuels once you get through the back and forth. But it is more of a, but you still need to put energy in to get it. It's not, you don't just dig it up at the ground and find it. It is. So I guess and it seems like the storage is quite difficult. So I'm just interested in terms of the hydrogen side, whether that's a potential in your mind with still a lot of hurdles to cross before it turns into something realistic, or if it's something you think it's more certain, that development. Because I sort of look at the big picture of solar and I go, I can't see how that's a problem. Whereas I look at the big picture of hydrogen and sort of go, there's so many losses in there, I'm just not quite sure whether.
Well, it depends what you're using the hydrogen for. If you're using it for transport, then it's got some disadvantages. It's also got some advantages. If it's more concentrated energy, then you can fit in a battery. So if you're taking a big load for a long distance, where weight's important, or if you take an aeroplane.
Yes.
And we're not there yet with a hydrogen engine for an aeroplane, but there could very well be some transport uses where hydrogen works. I think for the standard sort of use, driving a car around town, the battery will be hard to beat. But hydrogen's big use is and similarly for making electricity, both the Japanese and the Koreans are talking about importing a lot of hydrogen for electricity.
Right. Because they don't have their own resources.
Because they don't have their resources,
Yeah.
and that's going to be expensive, and much less expensive than using the renewable energy directly in Australia. But where it's certain to be big in Australia, no doubt about it, is where you're using the chemical properties of hydrogen in place of the chemical properties of carbon.
Yes.
And two huge uses, one turning iron oxide, iron ore into iron metal, where the hydrogen molecule plays the same role as the carbon atom. And the second is ammonia, which is the base for nitrogenous fertilizers and also explosives, and we use a lot of both of them in Australia.
Yep.
At the moment, we transform natural gas methane, converted through industrial processes into a mixture of carbon dioxide and hydrogen, and that's how we make ammonia. Take the hydrogen under pressure and heat and make ammonia. Very big emissions as you let out the carbon dioxide. But the alternative to that is that the hydrogen can be produced simply by running renewable electricity through water. That gives you electricity. Oxygen is a waste, and it's got some uses. Yep. And then you put the hydrogen through the back end of the process, which remains the same as making ammonia, the old Haber-Bosch process that the Germans developed in the First World War. The hydrogen's going to have big industrial uses in Australia, no doubt about that. It'll have some transport uses. It will have some peaking power uses. Yeah. How big the transport and peaking power uses are is not certain. Might be relatively small, but the total hydrogen story is going to be very big.
Yeah, and as you said, it's more likely to. It's much more effective if you're using the hydrogen basically where you're producing it. So you're producing it here and then using it, rather than saying, yeah, let's produce it here, stick it in a boat and send it all the way to Europe or something like that, because that's where you start to lose the whole.
Yeah, and it certainly won't be economic anywhere near it to put it in a boat or turn it to ammonia and put it in a boat and take the hydrogen out at the other end. That won't be competitive with Australia in industrial uses.
Yes.
If you need it to run transport or keep a house warm, you've got to have some form of energy, and renewable energy is expensive because they don't have opportunities for that. Yeah. Then importing from Australia will have a role, and there'll be some of that, especially to the big industrial countries in our region which don't have renewable alternatives.
Yeah, and I know you've got to finish up. Yep. Yeah, I don't know. Do you want to just flick quickly? I think we've hit most of these other ones, the other questions. Oh, evictions and bankruptcies is the only one, major one I wanted to ask you. Do you think... So we've got this big debt issue. Initially, there was all this issue with will the bankruptcies turn into a debt crisis and push on, but we let people push out their mortgages, and it seems as if we're through that problem at the moment, and the debt bubble will just get bigger, and the next crisis might be bigger, but it seems as if it's not going to turn into a debt crisis at the moment. Is that?
I think with these very low interest rates, and even lower than they were this time last year, I think that's not going to be one of the things we're worrying about in the year or two ahead.
Yes, yeah, excellent. I think most of the other ones we hit. Excellent. Thank you very much for your time. We really appreciate the having you on and your insights.
Good to be with you again, talking about these issues, and look forward to keeping in touch.
Excellent. Good on you, Ross. Thanks, and we'll make sure we've put all the relevant links in our show notes, and we'll share with your audiences as well. So thank you again for coming in. Look forward to getting you in soon.
Okay.
All the best. Thank you.
And we've got to catch up.
Yeah.
I will do. Very good. Okay, very good. So we'll jump across to our investment outlook and wrap up, Damien.
Yeah. So I think there's, obviously coming out of that, there's a lot of moving parts. I think it's safe to say a lot of the stuff Ross was talking about is aspirational still at the moment, and as he said, use my words right to keep him happy on that, is we still need to do more work to convince the polity about what needs to be done. I think there's obviously support, I think, in what Ross is saying in terms of the inflation side, is that there's a lot more work to be done, and it's not impossible that that governments can manage to turn this into an inflation story, and the US is the place to watch for that. But the default at the moment is that it's deflationary. We've got a lot of deflationary forces, some very short-term inflationary forces, but the deflationary forces sort of kicking through later on. The complication for investment markets for that is that longer-term rates do tend to be priced off the US, and so we're really coming back to now how dedicated is the RBA in terms of keeping our long-term rates low. Because long-term rates in Europe are negative in many countries, and a lot lower than the US, whereas Australian rates have pretty much been tied to the US, and so it's as we said, going forward, it's at the issue of if you can create inflation in the US and long-term rates go up over there, but you can't get inflation because of political choices in Australia, and you have a dedicated RBA in terms of keeping rates low, then you could very well see much lower rates. And so that's where a lot of our focus is going to be on the investment. For now, we've been playing the story as if we're going to see inflation and rotating into value stocks and really limiting our bonds to the very short end of the bond curve. The question going forward will be at what stage we flip. For now, we're pretty comfortable with that as a position of saying we'll play it as if there's inflation coming, but be ready to change that view because we do think the default is a bit of deflation.
Okay. Yep. Wonderful. Actually, just as you were running through that inflation answer there, or run through it, we've got a question here. Do you guys expect the inflation to keep prices rising post-pandemic? And if not, when do you think prices will come down? I feel like you might have just answered that one. So, you comfortable with that?
Yeah. There's another one in there about the power prices.
Around South Australia. It's the highest power prices in the world.
Yeah, absolutely. South Australia does have some of the highest power prices in the world, so it's absolutely right. I think the issue to go back to with that graph we were showing there is that idea that solar plus batteries is a falling curve, and we're reaching that level now, and it's actually one of the levels where South Australia is because prices are so low. So high. That's why they've managed to put batteries in
because they've picked it up early.
Exactly.
Yep.
So whereas, it's economic because the prices are so high.
Yep.
Whereas if you go to the US, there's not many places where it's economic because the prices are so much lower. And so, so I think that's not there yet. It's got to be cheaper enough to battle with the incumbents. Exactly. And so it's basically it's a bit of a view of the future. Yep. Is what you're seeing happening in there. And as those prices keep coming down for batteries and for solar, the rest of the world will start looking, or the rest of Australia first will start looking more like that. The US is a long way behind because the electricity prices are so low over there. You're talking, you'll be seeing it in Europe and other places first before you finally get through to the effects on the US. Is going to be one of the last ones. Absolutely, and it's not often that I hear the word South Australia and a view to the future used in the same sentence. So well done. That's right.
I'm sure you've made a few people happy in South Oz. Yeah. Fantastic. Thanks very much, Damien. Ross has had to shoot off with David, so they've shot through. But what we will do is jump through to our viewer question of the week. And we'd love to know what your thoughts are on what Australia's number one priority is for a reset in vein of today. It doesn't have to be something we've spoken about today, but we'd really enjoy reading your comments and viewpoints on where you think we could take the opportunity to have a reset going forward in the post-pandemic world. So coming up next week, we do then take a look at where we are in a potential commodity super cycle. As the world is tiptoeing its way out of the coronavirus pandemic, the consequent surge in the price of energy, metals and crops is highlighting the strengths of some economies and the vulnerability of others. There is a talk of a new commodity super cycle, which is raising the spectre of more damaging inflation down the line. But how likely is the current boom to continue? So tune in next week, Thursday the 25th of March at 12:30 p.m. for our thoughts on the state and prospects of commodities into 2021. Thanks to all of you who have tuned in today and watched in for live for another great episode. And of course to those who have asked some questions. I hope you've taken away some great ideas, and if you haven't already, feel free to click like on the video to give us some feedback. If you'd like to see more of our content, head on over to nucleuswealth.com/content to stay up to date on news from us. Follow us on social media. And finally, if you know anyone who'd get something out of today's episode, let them know about it, share with a friend and help our show grow. Thanks again for tuning in from myself, Tim Fuller and the team, and we'll look forward to catching you with the next one. Cheers.